Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and attention today and following along on the podcast. If this is your first time listening, welcome aboard. Happy to have you. And over the last few episodes, I've had a few conversations about how practice owners can choose retirement plans in the business, usually between a simple IRA plan or a 401k plan, and what type of 401k plan, and then really how to maximize the use of those different retirement plans in the practice, putting potentially over $100,000 away each year into these plans on a tax advantage basis. And if you look back at episodes 63 and 64, my conversations with Matt Ruttenberg were all about those things from the practice owner's perspective. And I'll put links in the show notes so you can take a listen to those episodes. But now I want to turn to and have a hopefully short conversation more focused on the retirement plan opportunities and options for independent contractor optometrists, or if you have a side income in addition to your regular W-2 work. Maybe you are working full-time somewhere, but you are associating part-time on a 1099 basis, or you're doing consulting or creating content or lecturing, whatever that is, for those independent contractors and for those full-time employed optometrists with side business income. I want to talk about the retirement plans at your disposal because you've got some unique opportunities, unique retirement plan options that W-2 employees just don't have. And as you know, as an independent contractor or as an optometrist with side income, there are both benefits and drawbacks to that situation there. Some of the things you need to think about are around tax planning. When you're on your own, you have to handle all of the tax withholdings for federal, state, local taxes, but also self-employment taxes, which is something you didn't really have to think about as an employee. That's actually an extra expense now. So there's planning around how to project out your taxes and plan for estimated tax payments so you don't get behind. At some point, sometimes it potentially makes sense to run the math and see whether you should create an LLC and choose to be taxed as an S corporation. So there's additional tax planning opportunities, and there are some tax benefits too. You can deduct half of your self-employment tax. You can potentially deduct health insurance premiums when you're self-employed, and you get to benefit from the 20% QBI deduction now that you are technically a small business owner when you're self-employed. So there are some benefits on the tax side as well. But outside of the tax considerations, you also have to think about recreating benefits, because when you are an independent contractor, you lose out on the potential benefits that you'd get as a W-2 employee. So things like the employee match or the employer match in a retirement account like a 401k or simple IRA, health insurance or other group insurance benefits, you lose out on those, or any state or local benefits that come with being employed. So you'd have to recreate those benefits on your own. However, being a very small business, you have retirement planning opportunities that you don't have as an employee. So I want to dive into what are the different retirement plan options and retirement savings options that are available to you as an independent contractor or as someone employed full-time with side business income, and how to make the most of them. So first up, I want to talk about the opportunities that you have that everybody has as individuals. And one of the first things that you have at your disposal is just a regular taxable investment account. It's not retirement related. The taxation's different than a retirement account. Sometimes they're called individual accounts or joint accounts or trust accounts if you have a living trust and it's under that. And that's something anyone can open. The opportunities to invest into it are unlimited. The access and flexibility you have to access those funds are also unlimited. So that's something you have at your disposal. And of course, you have your Roth or traditional IRAs. individual retirement accounts or individual retirement arrangements. And the max amount that you can put into the IRAs are $6,500 in 2023 if you're under 50. You get a little bump if you're over 50. And that $6,500 is a combined amount between all IRAs. You can't put $6,500 into the Roth and the traditional. It's a combined total maximum amount. And if you're married, your spouse can contribute as well. And for traditional IRAs, you receive a deduction on your tax return for the amount you put into it, and that's going to show up as an adjustment to your gross income. So right above that line where your AGI is, it's going to be in that area. But keep in mind with the traditional IRA that there are pretty relatively low income levels to keep an eye on. That where if you or your spouse have access to a retirement plan, either in your business or at her work or his work, you start to lose eligibility to get that deduction, right? So those traditional IRA deductions can start to become non-deductible. For the Roth IRAs, you don't get a deduction, but you can withdraw all of the growth in the account tax-free in retirement as long as the rules are followed. So it's sort of the opposite there. No deduction today, tax-free growth into retirement. And with the Roth IRA, there's a similar income limit to look at. If your income gets to a certain point, you're either going to be limited or unable altogether to contribute directly to a Roth IRA. So in 2023, that starts when your modified adjusted gross income gets to about $138,000 if you are filing single, or $218,000 if you're married filing jointly. If you file taxes separately, for example, for student loan reasons, then that actually starts at $0. And in that case, if you start to see your income get to that level, you'll have to really do what's called a backdoor Roth IRA contribution. And what that is that you first contribute to a traditional IRA, and that is a non-deductible contribution. Then you convert or transfer those funds out of the traditional IRA into a Roth IRA. So it's a similar end result. Those funds end up in the Roth IRA, but there's a few extra steps and details in between. And one thing you want to make sure you keep an eye on if you're doing that backdoor Roth IRA contribution is to make sure you don't have any other pre-tax IRA dollars. Even if it's a simple IRA plan or SEP IRA, because those pre-tax IRA dollars are going to make it messy and cause some of that conversion to be taxable. So keep an eye out for that. If you do, some things to think about are potentially roll those pre-tax dollars into a 401k plan if you have access to one, but just keep an eye out for that. And be sure, if you do this, that there's a Form 8606 in your tax return moving forward to track all of this activity. So IRAs are another option that's available to everybody, whether you are a business owner or not. That's something you can use. The next step, something that's unique to you now as someone that's self-employed or as the owner of a small business, is the SEP IRA. So the first thing I'll talk about is the SEP IRA plan. And this is sort of like a light profit sharing plan for your business. And it allows your business, not you as an employee, but it allows your business to contribute into the plan on your behalf. And the limits for that are if you are self-employed or if you're an LLC and you haven't been chosen to be taxed otherwise. The limit is around 20% of your net income from self-employment. And essentially, as a part of that calculation, you need to start with your net income from self-employment and subtract out the deductible half of self-employment taxes as well as the contribution itself. So in the end, it ends up to be somewhere around 20% of your net income from self-employment. If you own an entity that's taxed as an S corporation, it's a little different. You can put up to 25% of the wages that you pay yourself. So not the profit, just the wage that you pay yourself. So for example, if you are taxed as an S corp, your total income was $180,000, but $100,000 of that you paid yourself as a wage. $80,000 of that was profit. You can only contribute up to $25,000, which is 25% of $100,000. And the absolute maximum that you can put into this SEP IRA in 2023 is $66,000. So if your net income is high enough to where 20 or 25% of that would be higher than 66,000, then 66,000 is the absolute cap. And with SEP IRAs in the past, you were only allowed to do pre-tax contributions. But thanks to the recent Secure Act 2.0, by law, you can now do Roth contributions in both SEP IRAs as well as simple IRA plans. I don't know if any providers actually allow you to do that yet, if they figured out how to allow that. But by law, you're able to do that in the Roth bucket instead of pre-tax. So the deadline to both open up and fund a SEP IRA, so to get it started and to put money into it, is the tax filing deadline for your business, including extensions. So if you're a sole proprietor or if you're an LLC and you've not made any special election to be taxed differently, that's going to be your April tax filing deadline, or if you extend in October. But keep in mind, if you are taxed as an S corporation, you have to file that 1120S tax return in March. So it would be your business's tax return deadline. So that would be March in this case, or if you extended later on in the year. And so that's SEP IRA. That's sort of option number one to think about. You can also do a simple IRA plan, but I'm going to skip through that entirely because I'm going to jump to what is next and what I feel is often the preferred route for an independent contractor, or even if potentially if you're just working with side income, and that is the solo or individual 401k plan. And solo 401k plans are 401k plans that you can set up in your business or for yourself as someone that's self-employed, as long as you are the only employee of the business, or with the exception of your spouse. So either you or your spouse. And solo 401k plans have the same total maximum limit that you can put into the plan as a SEP IRA if you're under 50. And that's $66,000 in 2023. Or up to your total net income or total compensation, right? So if you've only earned $50,000 with your self-employed work, well, you can't put that full $66,000. You're limited to that $50,000. So you can't put into the plan more in total than you actually earn in the business. If you're over 50, however, there's an additional $6,500 catch-up amount that you're allowed for the 401k plan that you don't get with the SEP IRA. And what's really different about the solo 401k, and what tends to make it better, or one of the things that makes it better, is that total $66,000 total limit is broken up into 3 layers, just like any other 401k plan. You have your employee contribution, which is sort of that bottom layer. You have your employer contribution or profit sharing. That's what you as the employer can put into the plan. And then you have after-tax contributions on top of that. And that all fills up to the total of $66,000 in 2023. So let's break those different layers down. So for the employee contribution amount specifically, you as an employee, you can put into the plan $22,500 as an employee, or the additional $6,500 if you're over 50. And it doesn't matter how you're taxed. You are both the employee and the employer of your own business. So as an employee, you can put in that first layer of $22,500 as an employee. And that $22,500 is one total employee limit across all the plans that you're involved in, regardless of how many employers you're working for, of how many 401k plans you have or simple IRA plans you have. That $22,500 is the maximum employee limit across all plans if you're under 50. The next layer is the employer contribution or profit sharing. And just like basically the same calculation as a SEP IRA, as the employer, you can put up to roughly 20% of your net self-employment income or 25% of the wage you pay yourself if you're taxed as an S corporation. And you can do that up to the $66,000 max. If you've got enough additional income from your work, you can do profit sharing up to that $66,000 max. And just like the SEP IRAs, historically, you could only do pre-tax for the employer portion. But thanks to the Secure 2.0, you can now legally do employer contributions, so whether it's match or profit sharing, into the Roth bucket as well. You wouldn't get the deduction, but it would grow tax-free in that Roth bucket. So that's the second layer, employer contributions. The third layer that's available to you in a solo 401k plan is the after-tax contributions. So how do those work? What are after-tax contributions? Well, by default, these contributions are after-tax and can't be deducted, right? So it's just after-tax income going into these accounts. They would sort of work as basis in these accounts. But the growth of the after-tax contributions are pre-tax, meaning that if you were to withdraw them in retirement, the portion that's growth will be considered taxable income. But your contributions wouldn't. Those are after-tax and already income that's taxed. However, these after-tax contributions in the 401k account can set up what's called the mega backdoor Roth. And similar in concept to the backdoor Roth IRA contribution we talked about earlier, you can make these contributions in after-tax dollars, right? So you make these after-tax contributions, then you can convert those after-tax dollars into the Roth bucket within the solo 401k plan. This is happening inside of the plan. You don't have to distribute it out of the 401k plan. And if there's any growth, that would be taxable income, but if done pretty quickly, you shouldn't see much growth. And what's really cool about this after-tax contribution is that you can do the entire $66,000 in your solo 401k as an after-tax contribution. You don't even need to do employee contributions, employee deferrals, or profit sharing. It can all be done as an after-tax contribution. So, for example, you might want to do the $22,000 $500 as the employee amount. And then if you want the entire account to be Roth after-tax dollars, you can do the rest up to $66,000 with after-tax contributions and just do those conversions in the plan. Of course, you do have to have the income to do that, right? So you're limited to how much income you actually earn. But that third layer really gives you that flexibility to fill up this 401k plan up to that full limit. And the after-tax contributions are something that's not usually available to private practice owners because you'll tend to have safe harbor type 401k plans so that you as the owner or the ODs in the practice can fully contribute. And after-tax contributions opens up the plan to testing requirements that you usually avoid with safe harbor plans. So with larger employers like the Kaisers or maybe large corporate employers, you may see these after-tax contributions available to you if you're employed there, but private practices don't often see that. But it's something that's available to you as an independent contractor with a solo 401k. And the deadline to establish and fund a solo 401k for the profit sharing and the after-tax contributions only is your business tax filing deadline plus extension. And keep in mind, again, that S-Corp has the earlier tax filing deadline a month early. So if you are taxed as an S-Corporation, keep that in mind. But for your employee contributions, those need to be done within the calendar year, just like payroll. But for that employer, the profit sharing and the after-tax amounts, those can be done after the new year, before that tax filing deadline for the business. And thanks to the Secure Act 2.0, if you're a sole proprietorship, you can actually start and open the plan and fully fund it, meaning both the employee and employer and after-tax contributions after the new year up to your April 15th tax filing deadline. And this is only available in the first year, not including extensions. So that's something you can do if you are a sole proprietorship. And there are a few reasons why solo 401k accounts tend to be more favorable in my eyes to SEP IRAs. The first thing is that you can potentially put more into the solo 401k plan than you can with a SEP IRA with less income. So just as sort of an extreme example, let's say you had side business income and you only earned $30,000 in net self-employment income. With the SEP IRA, you're limited to about 20% of that $30,000 as a contribution. But with a solo 401k, you can put the full $22,500 as an employee or up to the full amount of $30,000 with after-tax contributions. So you with these different layers in the plan, with the employee amount, the employer amount, and after-tax, you have more opportunities to more likely put more dollars into a solo 401k account than you would with a SEP IRA at lower income amounts. The second thing is that there are more features available in the 401k. For example, the after-tax and catch-up contributions. You can take loans from the plan, for example, like you could any other 401k plan. So there's more options available to you with the solo 401k. And another thing is that solo 401k plans don't negatively impact backdoor Roth IRA contributions. Pre-tax dollars in a SEP IRA would, just like simple IRA plan dollars, just like a traditional IRA plan. Pre-tax dollars in a SEP IRA create issues when you're trying to do that backdoor contribution. But 401k plans, including solo 401k plans, do not. There are a few more administrative things to think about in a solo 401k than there are with a SEP IRA. SEP IRAs are pretty easy to establish. So let's talk about some administrative things with that solo 401k. The administration's pretty light compared to your typical 401k plan, where there are employees and you have to have an administrator and you're subject to ERISA requirements and things like that. With the solo 401k plan, no employees other than your spouse. You're not subject to ERISA laws. You're also not protected by ERISA laws as well. But so there's fewer things to keep in mind. There's fewer costs that go along with that. So don't be intimidated by that. But the first thing is, if you ever have employees that aren't your spouse, this is going to convert that plan to a full-on 401k plan. So be very mindful of that if you're ever in a side business and you're planning to hire full-time employees. Keep that in mind. You want to be really careful about that. A second thing to think about is you're likely to want to get a separate EIN number. Even if you are a sole proprietorship, you may have just been using your social security number. Well, you're going to want to get an EIN number for the solo 401k plan. This can be done for free. Keep this in mind. You don't have to hire someone to do this. This can be done for free at the IRS website pretty easily. So that's something to keep in mind. For S corporations, keep in mind that you'll need to run your employee contributions through payroll, just like your wage paychecks. So that'll have to be done as a part of payroll. And employer amounts should come from your business bank account, so that profit sharing amount. With a solo 401k account, you do have to have a plan document. You can go to one of those big financial institutions that you're probably well aware of, and you can get sort of a boilerplate, off-the-shelf, IRS-approved document. And usually at no charge, relatively straightforward. The only issue is that they tend to be pretty limited on what you can do. For example, many don't offer opportunities to do Roth contributions, even as an employee, or after-tax contributions, or allow for loans. So if you just want to make simple pre-tax contributions with no frills, then that can definitely work. It's simple, straightforward. Or you can hire a company to write up the plan document for you, and then you can open up generic retirement plan, or sometimes they're called like pension trust plan accounts at some custodian like Schwab, which is where my firm custodies, and you can create whatever plan features you need based on your situation. Another administrative task is that once the solo 401k plan gets to $250,000 of assets or more, you're going to have to file what's called a Form 5500 Easy each year, which is sort of like the informational tax return of your 401k plan. And if you hired a company to write up that plan document, sometimes they'll do this for you, or sometimes your tax preparer can do this for you as well. But that's something you'll need to keep in mind when your assets get to that level. So those are some things to keep in mind administratively with the solo 401k plan. But I tend to lean in that direction by default, unless the cash flow is just not that high in that side business or whatever it is, and there's just no need for it. But I tend to lean towards that solo 401k plan over and above that SEP IRA because I just think the added features and the ability to do backdoor Roth IRA account contributions and not have that impacted, and the after-tax mega Roth IRA account contributions, those features I think are more favorable in that solo 401k account. So those are sort of your options as a 1099 OD, depending on your needs. You can sort of select which ones based on the amount you want to contribute and what you want it to do for you. And one thing I always bring up is that your solo 401k plan and also the SEP IRA plan contributions do impact that 20% QBI deduction. If you're self-employed, meaning you are a sole proprietorship or you are in LLC, for example, and you've not been choosing to be taxed any differently, pre-tax solo 401k contributions or SEP IRA contributions will lower your QBI deduction. It's going to impact that. So check out my episode on an optometrist's guide to the QBI deduction. I'm going to throw a link to that in the show notes. But when you calculate this 20% deduction, when you calculate it, you have to start with your net income from self-employment, and you have to subtract out a few things from that before multiplying it by 20% to figure your deduction. And your pre-tax contributions are one of those things that get subtracted from that. So keep that in mind. The effect essentially is that you only get a partial deduction for putting money into the plan, but when you withdraw it in retirement, it's going to come out taxed at 100%. So you do want to take a look at some math there to see, and just to confirm that it does make sense to use pre-tax contributions in that scenario, or whether Roth contributions are the better route. One thing I wanted to mention is how you can benefit from a solo 401k plan if you are employed full-time but have that side business. I want to talk about how having multiple employers with multiple retirement accounts impact you and some of the planning that can go along with that. If that's you, you can use a solo 401k plan in addition to your retirement plan at work to put even more money away for retirement in a tax-advantaged way. You can contribute to both your retirement plan at your full-time W-2 job, then again in your own self-employed solo 401k. So let's break down how that works with multiple employers. We talked about those different layers. And the employee maximum is, again, $22,500 this year. And that is a single total max limit across all employer plans. So if you're employed at 5 places, you can only put in $22,500 as an employee across all 5 of those retirement plans. Same thing if you switch employers. You'll need to track how much you contributed in your first employer, and most ideally, let your new employer HR department or administrator know so you don't over-contribute. Or even if you switch plans, for example, next year, thanks to the Secure Act 2.0, you can switch from a simple IRA plan into a 401k plan in the middle of the year. Before you couldn't do that. And so if you're doing that transition, you'll have to make sure you're tracking how much your employees and you as an employee put into the simple IRA, and make sure you don't over-contribute in the 401k plan when you make that transition. So that's as an employee. However, the total combined maximum limit of $66,000 is a total limit per separate plan per unrelated employer. So that's a $66,000 total limit for your full-time W-2 job 401k plan, and then a separate $66,000 limit for your side business. And let's say you max out your $22,500 employee amount in your W-2 job. You can still put in up to a separate $66,000, assuming you have enough income to get there, right? So limited by the amount of actual income you're earning in your solo 401k plan with your side business. And that can be profit sharing or that after-tax amount. So you can decide whether you want to use the profit sharing to get that deduction and also impact that QBI deduction as well, or use those after-tax contributions in order to get that in the Roth bucket. So this can lead to a pretty substantial amount of additional retirement savings in that extra plan. And in fact, it may make sense to, if you're going to use pre-tax contributions somewhere, it may definitely make sense to lean on those contributions and max out your your 401k plan, employee contributions at your main job, and then use any Roth contributions in the solo 401k to preserve as much of that QBI deduction as possible. So hopefully that is clearer than mud, and hopefully I'm not making a mess of that whole discussion around how that works. But if you have a full-time job somewhere and you have a side business elsewhere, there's definitely opportunities to open up another retirement account and add additional dollars, because you have a separate maximum limit up to that $66,000 if you're under 50 per separate employer plan for unrelated employers. And this is, I want to emphasize, unrelated employers. So I'm not talking about you owning a practice and then you owning a side business. For example, you own your private practice and you own a technology company on the side. I've seen that a few times. If there's common ownership here, that can open up a can of worms, that can create a mess. Listen to my second half of my conversation with on episode 64 with Matt Ruttenberg. He talks about controlled groups and how common ownership across different businesses sort of impacts your plan. You don't necessarily want to do that lightly. I'm talking about totally unrelated employers where you don't have that common ownership issue. So hopefully this is a pretty helpful overview of your retirement plan options as either an independent contractor, 1099 optometrist, as well as someone that's employed full-time with side business income. You have additional retirement planning and tax planning levers available to you that an employed optometrist wouldn't have. So let me know if you have any questions. You can reach out to me at Evon, EVON, at optometrywealth.com. And you can check out all of the links and resources I mentioned here in this episode in the show notes of this episode. You can scroll down in whatever app you're using to find those, or you can check out the show notes at the Education Hub on my website, www.optometrywealth.com. And of course, while you're there, feel free to schedule a no commitment introductory call. We can talk about how all of this works and anything else that's on your mind financially. And we can talk about how I serve optometrists and help them navigate decisions just like this all over the country. Lastly, if you're not ready to chat, for my optometry listeners, I'm offering free financial health assessments. That is, you can download the financial planning app I use with clients. You can enter in your information and I'll send you a video talking about what the scores mean and giving you an assessment of your own financial health scores. So I'll put a link to that in the show notes as well. And with that, really appreciate you listening. We will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.